There you
All
go.
right, Monday morning industry update. Let's rock.
Monday morning.
Well, it's Monday. All right. Fulton County, 764 actives. I think that's a healthy number for us. I think that means that there's enough inventory out there. We're not coming from a place of lack or scarcity, meaning I think if you've got a buyer, you got a good opportunity to go out there and show some houses right now, where I wouldn't have said that 6 months ago. All that being said, 276 pending is a little off on where we were the last couple of weeks. 225 closed is a lot off over where we were the last couple of weeks. However, I want to caution you and remind you, our real estate market is so calendar sensitive, Jason, that it's crazy. And so I could actually see this number or see this number, and I could actually get some anxiety or some fear around it. And I bet you there's a media outlet that will write some fear around those numbers. However, Yes, what?
No, I was going to say, well, yeah, they have to sell newspapers and ad clicks and things like that. So of course they're going to write that.
If you go back and look in the calendar, we had another date here in May, right? And the bottom line is, you realize here's what our calendar looks like. Is we've got Memorial Day weekend, which sometimes is a 3-day holiday. We have Juneteenth, which is sometimes a 3-day holiday. We have 4th of July, which sometimes is a 3-day holiday. And we have Labor Day, which is sometimes a 3-day holiday. If you don't think that doesn't disrupt the real estate market, you're crazy. It does. And that's what you're seeing this week, is disrupted numbers because of the 4th of July holiday. So I'd tell you to average things out over 2 weeks, 3 weeks. I think numbers actually are perfectly fine. You're just down for one week. Now, I might be singing a different tune next week, Jason, if numbers don't come back up, but I think we'll be just fine.
Well, sorry, I didn't mean to interrupt. If you look at the chart that you have just below that, and you look back at the last week of May, there's this really big dip in listings, in active listings.
Yeah.
Add 30 days to it, guess what? Now we're having a dip in closings, and it coincides.
Yeah, absolutely. And this is Memorial Day. This is 4th of July. And I actually think we saw a little dip around Juneteenth as well. Dekalb County, same deal. 458 is a healthy number of active listing inventory. 148 pendings dropped down a little bit. Closings came way down in DeKalb County. Same story. We think it's a holiday disruption. Cobb County, another big county, 565. Really good, healthy, active inventory. Pendings held in Cobb County, but solds dipped as well. Same story. I don't think it's any newsworthy news right now. It will be next week if we don't kind of hit it back to our normal numbers. But look at this line in Cobb County of active inventory coming up. And you do kind of see a trend line to this coming down a little bit, which speaks to the shift that we kind of all know is coming. But at the end of the day, man, the word shift to some people means fear. To professionals, it means opportunity. And that means a professional knows how to navigate what's before them and goes and finds the opportunity. I think I would be calling every buyer that I had walk into an open house, internet lead, anything right now, and getting them back onto my pipeline engaged, because the opportunity is there's inventory right now and the rates aren't as high as they're going to go. So I still have opportunity in pulling that forward. Would you add anything?
Yeah, actually, I mean, in the last week, rates have gone down. And also I'm seeing lenders like Shelter, for example, that's offering a lock and shop. So we can lock the rate today. And then as long as you close in 45 or 60 days, depending on the program, you get today's rate, not the one that happens after the Fed meets at the end of July and raises the rate again.
Yeah. All right. So here's an interesting article on Inman. It says they're seeing contingencies come back. And when I first read this, I started I think of the old school contingency, like I got to sell my house before I buy the next one. But I actually think contingencies in this case is financing contingency is back in play in a lot of markets. Appraisal contingencies are back in play in a lot of markets. And so if I'm strategic as a listing agent, of course I want all that taken out of the contract, but I may need to set some expectations with sellers that, hey, this is a pretty normal thing to our contract. It's not what we experienced over the last 9 months, but man, be ready. These are back in play. And maybe it's time to re-up. Maybe I hired an assistant in my business that's not used to checking critical date letters. And maybe I need to have a conversation with my team around critical dates. But at the end of the day, I think it just means we're shifting back away from that acute seller's market to where buyers are, I don't want to use the word normal, but I think we're going to be normal buying and selling for a while here.
Well, it's more normal for sure when you have a balanced market between buyers and sellers. So the market determines, or dictates how hard or how far you can press, a one-sided contract for sellers, which we've had for a while. No contingencies for appraisal, inspection, finance, all cash, perceived all cash, non-refundable earnest money. But as fewer competing offers come in and sellers maybe lose a little of that self-confident, no matter what I win, then, that's where your expertise and professionalism in your micro markets pays massive dividends for your clients. Because again, Northwest Cobb County and Southwest, in town, you name it, they're all different markets. And 100%. 3 offers come in the same day. The psychology is different than one offer after 30 days of being on the market.
And to your point, Rick, I think a $300,000 sales price is going to look very different than $1 million plus. Like, I think those offers are going to look very different. And I just think this is it's pro time, we call it. So the opportunity of being a professional and just kind of knowing how to give the right advice and opinions to a buyer in this market, and the right advice and opinions to a seller is everything. But at the end of the day, I actually think contingencies are healthy for our industry. I think the acute taking out the appraisal contingencies and financing contingencies, that's a little bit of the Wild West in our industry. So this is actually a healthier way of doing business. So I'd see that as a good thing. Another thing that's noteworthy, we've talked about this on here before. We thought the class action suit with NAR around the way buyer agent commissions are paid went away. It's resurfacing with some new energy around it. Here's what I'm just putting out there. I don't think you should focus on this. I think you just need to be aware of this. And what I think this tells us, and can I just be as real as real? Years ago when I'd sell real estate, Deborah Blue's on here, so don't judge me, Deborah. I might have had my buyers sign the buyer representation at the same time as signing their offer. And I did it because my office made me turn it in for paperwork. And I understand that is a practice of a lot of real estate professionals. Here's where I would take this conversation and turn it to a practice of the future. Is I think it's an opportunity for us to up our professionalism as real estate professionals. And what that means is we get into a written agreement with a seller before we ever conduct any kind of agency relationship. They sign the listing agreement. We're an agent. We represent their property. We should be doing that same practice with buyers. We should sit down, do a buyer consultation, in writing, create an opportunity of agency, and that opportunity of agency eliminates this entire conversation here, because you're a professional, you charge a professional rate. It's certainly a part of it, and I'm not going to act like I was perfect either, because I'm admitting I wasn't, and I know there's others on the call that do their business the same way. But I think it's coming where we need to take our buyer representation more professional, more serious. And what that means is getting that agency relationship established much earlier in the process, not at the 11th hour. Would y'all add anything?
I will say this. You have to, the reason that this is even a thing is because you have agents out there that aren't explaining it to their clients, period. Yeah. And we're just handing them a document. We know that they're not going to read it because it's electronic signatures. They sign it 45 seconds after we send it to them. We know they didn't read it, and we didn't stop and take the time to explain it before they even signed it.
Yeah.
And that's what's caused all of this.
Yeah. All right. So the next conversation, before I click on it, if you're asked in conversation, what are the mortgage rates? What are you quoting?
It's a test to see who's on the call actually
This
listening.
week? You're talking about this week?
Yeah, I meet you for lunch today. What are you quoting?
5.75.
Okay. Somebody else.
Is that a 30-year fixed?
5.6, Bob Seymour.
5.84.
5.84. If I click mortgage interest rates today in Georgia on Google, it says 6.5 on a 30-year fix. Now, I do think our lender partners can do much better than that.
And you need to use my lender then.
Yeah, I understand. This is Google mortgage interest rates today in Georgia with a 700 credit score, 20% down, 6.5. So I think our lender partners can do a lot better than that. But the point of this is, are you prepared to kind of track this? Because I think agents need to kind of have a roundabout understanding of what rates are looking like these days as they're moving. And it's just part of being professional. So kind of keeping your head on it. One of the things that we heard, and Jeff, you made a mention, and I heard it as well, is that rates came down last week. If you go look at the 10-year treasury, and let me pull up a 30-day window here. We're definitely down on the 10-year treasury, which tracks the mortgage interest rate over the last 30 days. So in theory, the interest rate should be moving in a positive direction, yet it feels like the energy of increase has been taken out of the air. It feels like it's just kind of floating right now. There's not a energy that's out there where they're just trying to jack them quickly and fast anymore. That's an opinion, not a fact. Any thoughts about interest rates and where they're going, guys?
Well, my experts that share their knowledge with me have also shared that it's not uncommon that when there's predicted rate increases at the Fed level, that they build those rate increases into mortgage interest rate hikes in advance, and that some of them are predictive. So there's not always a one-to-one correlation. And one reason they may have come down, in addition to what you're showing, is that they've predicted these rate hikes, and maybe there's positive, information to, I guess, to stymie a little of the fear over inflation and imminent increases in the future. But they don't, I don't think it's like one-to-one, like the minute they raise or lower, there's not an autonomous, like an auto button that kicks off.
There you go. So anyway, I just, I wanted to bring it up today and give some encouragement to everybody you might need to engage in that conversation a little more, just because it's a fluid conversation right now. And just kind of have some roundabouts of where that's going.
And Brian, I want to add something real quick. Today on the broker chat, Deborah Blue went over a special step that apparently has existed forever that protects the buyer in case there is a major swing. and you can put that in the contract to protect the buyer. So, and also the seller, depending on how it's used. So if you didn't see that conversation today, go back and watch it because it was a great conversation.
Deborah, why don't you give us a teaser and then we'll send everybody the link. Deborah Blue. Saw her on here.
She clearly took a call. She's working on a broker issue.
She's scrambling. She's going, oh no, Brett's calling on me. All right, moving on. We'll come back to her. All right, so there was an article in the Atlanta Business Chronicle about Home Sweet Home. After struggling through the pandemic, some hotels are seeing a growing source of revenue. TV and film crew pouring into Georgia right now. And then the conversation kind of moved to Airbnbs. Is Airbnb in Atlanta a very viable investment option around the film industry? What do y'all think?
There's no way it's not.
So where's the areas? Where would you be buying Airbnbs?
You know, in Virginia Highlands, there's a famous inn there that's been there forever, the Highland Inn. They closed maybe a year ago, and they have come out with a model where they have completely furnished every room, and they're doing short-term leases, and they are saying that they're trying to attract people that are moving here that need a place to go for more than a weekend, but less than 6 months. And same thing with the film industry. And quite honestly, I thought it was brilliant. Their marketing spin was great. We're not trying to do, oh, we're Airbnb, but they're like, hey, you're here for a little while, or you want to get situated in town. We've got internet, we've got furnished places. And I thought, brilliant. Why couldn't I have thought of that?
So where's the opportunity in that, Jeff?
On another hotel that's going under, small hotel.
I think Airbnbs, multifamily, any of those are opportunity. And I think
just the marketing of it, though, you know, not Airbnb and not, you know, they want to cater to, you know, they pulled on your heartstring a little bit. Hey, you know, I know someone that's moving here that wants to get set up, and they don't want an apartment lease. And I thought that was just brilliant.
There you go.
And it probably depends on the clientele, whether it's, you know, your frontline worker versus, you know, a superstar looking for a gated community with, you know, exclusivity and, you know, security, if you will. But we've had many clients lease, and there's usually confidentiality agreements, and you just need to know the ins and outs before you jump into that game.
Of course.
And like you guys talked about last week, Brett, with Mark, the city council, you know, for Atlanta and Sandy Springs and other municipalities are cracking down so much on Airbnb. You know, come November, you can't have one in the city of Atlanta unless you're a resident of the city of Atlanta. You know, there's fines and things involved. So I think that what you're seeing in this, the part of the huge construction project they're doing at Pump City Market is to create a hotel that is nothing but short-term rental. As a hotel, is because of the reaction to that Airbnb stuff that's happening in Atlanta. I think Airbnb is starting to, unfortunately, get a bad reputation in Atlanta. Neighbors don't want it on their street, etc. They'd rather have someone there for a year than someone there for two nights.
Sure. Well, at the end of the day, I'm not here to say exactly how to do it. I just want to bring concepts and what I think is opportunity. And I see this as opportunity for some that are wise enough to figure out how to play chess and figure out how to turn this into opportunity. So popping it on here. The other thing I wanted to bring up, and then Jason, if you want to go through some of the chart masters, you can share your screen. The rents are going through the roof, guys. And a perfect storm fuels big jump in apartment rents here where they are rising the most. If you look at this rental rate here, second quarter 2018, the rent was $13.47 basically for your average apartment, right? Average rent. And it went to $14.10, $14.23. It kind of held at that $1,400 range for almost 2 years. And now it's jumped to $17.36. You know, every time I think of like a first-time home buyer or people in rental, I always go back in my head to when I was a first-time home buyer or I was a renter, and the sticker shock to pay a $1,700 for a month for an apartment on a starting salary coming out of college just sounds crazy, right? But remember, this is the theme. If rates go up rental, where's our opportunity?
To convert them to buyers.
Okay, how so?
If they're paying that much in rent, guess what? They're paying someone else's mortgage, property taxes, homeowner's insurance, and profit.
Mm-hmm.
So if they can afford to pay that person's mortgage, they can afford to pay their own.
Okay. So I definitely think it pushes people back into homeownership. The higher the rent goes, the easier that conversation is to be able to convert them back to home buyers. I also think there's an opportunity for investors here.
Mm-hmm.
I think, if rental rates sat constant over the last 3 to 4 years, but the cost of acquiring property went astronomically up. If rents catch up, properties that might have been deemed not great cash flows might be catching up on what a good cash flow might look like if rents are starting to progress. That makes sense?
Yeah.
100%.
Yeah. Anything you'd add, Rick? You're an investor.
I mean, on the investment side, yeah, it's all about cap rate relative to what the cost of money to borrow and cover the debt. So it's really a relationship between the cost, not only the acquisition, the carrying cost, but also correlated directly to rental increases, which that's one of the reasons rental increases have probably gone up, is there's been speculation, it's supply and demand driven, and also, speculation around a cap rate that's acceptable to invest. And margins are really thin right now. I'm seeing 4, 5, 6%, which is uncommonly, maybe not uncommonly, but it's low relative to some market opportunities.
Yeah. All right.
But it's having a consulting conversation with your clients around, if you're paying $1,800 and you're not getting the tax advantages, appreciation, or accelerated depreciation, if it's an investment property, there's still strategies that live inside of this year that if you deploy, you come out ahead in a big way. So again, it's a financial conversation and a wealth building conversation that all professional realtors should be skilled at.
There you go. Jason, why don't you pop up and give us 2 or 3 talking points out of Chart Masters you saw?
All right. So Rick already said it, but I just want to use this as an example. Each market is different. Each neighborhood is very different. So you need to know what's going on in this specific market. So this is Midtown Detached for June. One of the things that we've been talking about on this call and other calls and team meetings and et cetera is, hey, sellers, get ready to expect longer days on market. Unless you're in Midtown and in the luxury price point. These are negative days on market, substantial negative days on market in that particular neighborhood. Looking at the supply as well, I mean, you're doubling the supply in the 750 and the $1 million range. So you just have to make sure that you're looking at specifically what's happening in that neighborhood versus, if we look at the overall, days on market, we have up 57 up until you get to 500,000, up 12% at 300 to 500, then it starts going down. So remember that when it's year over year, we're comparing what we did last year, which was also being compared to 2020, which is nuts. So
why do you think that is? Why do you think over 500 is going down?
Because I think it did slow down last year. I remember seeing in one of the quarterly reports where the inventory for luxury skyrocketed. It still didn't get to that buyer's market part, but it went from a little under 2 months to a little over 4 months in supply. I think also last year we had a lot of new construction that was in that price point, and in those price points get completed, and they were taking a long time to complete, but they were listed. Does that make
And
sense?
this shows percentages, not the raw numbers. So it also
Exactly.
helps to look at the raw number to know how many actual homes, what is the actual median days on market, and then what are the actual listed and failed. I mean, all of these are percentages, which tells you kind of a trajectory year over year, again, for the same period. And the goal is to take out seasonality to make sure that you're not skewing your perception. But at the same time, raw numbers matter. Sometimes like the million to 149, granted, Midtown probably has quite a few in that bucket, but if the further, the more suburban, it might be 10 or 15 houses total, and an anomaly sale could shift that.
Yeah. And when you're seeing things where supply is up 100%, that could easily be, we had one house last year and this year we have two.
That's exactly right.
So the percentages you do have to be careful with, but looking at the trends of what's going on. And when I went through this today, what was really dramatic is seeing the variation of the neighborhoods, how much pink, how much green, how much yellow between the neighborhoods inside 285.
Well, everything's changing. And I think just like interest rates, rental rates, neighborhood statistics, it's pro time. Like, we need to dive into this stuff and really kind of be in tune with things changing, because when they're on a trajectory line, it's pretty easy to predict. But when things are changing, prediction kind of goes out the window if you haven't studied it and stayed up on top of it.
Good.
You first.
No, I was just going to say absolutely. And then this is truly where that skill set comes in, because if we have a conversation with a seller today in a particular price point in a particular neighborhood, and they call us a month and a half from now and they say, well, this is what you told me a month ago, we have to communicate today and a month and a half from now that the markets are changing daily. And like what I say today may not apply a month from now.
Perfect. Well, we'll get Deborah Blue next go round. She's got a great logo, at least.
Yeah.
There you go. All right. Y'all have a good one. Happy Monday.
All right. Happy
Afternoon.
Monday.